Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about US Steel. So US Steel has started to move up the shares as have a lot of commodities. And I think that, this is a space that has been so starved of investment for quite a while that investors just want nothing to do with it. And I was looking through this and, the big question mark that is outstanding here is clearly 2022, the second half is going to be tough for US Steel. There's just a question mark of how much revenue growth rates decelerate in the second half of 2022. That being said, I think that, paying just 2 times this year's free cash flow, I think that that's probably pricing in a lot of negativity already. So let's just get into it. So, commodities, I've just kind of highlighted a bunch of commodities. They're all moving up and to the right. It's quite interesting to see that because in the backdrop, if you've been investing in kind of small and mid-cap tech stocks, it's just the opposite. It's just like you've just been getting absolutely killed. And it's kind of interesting, that setup, that this space is reasonably well disposed. Yes, there is some kind of oil play here, but not all of this is to do with oil. It's just that commodities as a whole, there's a lot of demand for them, and it appears to be the case that they're very cheaply valued. Okay, so as I already alluded to in the introduction, revenue growth rates are going to decelerate in the second half of 2022, okay? But that's, if you think about it, right? So the second half of 2022, they're coming up against a really tough comp with the second half of 2021, where the revenue growth rates from US Steel were up in the triple digits. So, it's a cyclical company. It's going to have ups and downs. That's part of the idea here. But for all intents and purposes, I think that investors are really just being very bearish right here. So I already described this quite a few times. Q1 is supposed to be particularly strong, and then after Q1, as we step sequentially into Q2 and onwards, there's going to be a decrease in the revenue growth rate, so that it's going to exit Q4 2022 at approximately negative 20%. Okay, so that's quite a large discrepancy between the start of 2022, the first quarter, and how it progresses throughout the year. So investors are really kind of like, oh my god, this is like, really awful. So during the earnings call, US Steel, I like this one here. So they say, we know about risks, we know about the Fed taking rates up too fast, unexpected changes to import restrictions, geopolitical risks, existential risks. The risks are many, but we've seen it all before. I mean, they're going to say that, right? But I think that it's, giving investors what they want to hear because, at least we're all on the same table. We all know there's a lot of risk on the table, and I think that's kind of helpful. There's supply chain issues also playing a role there. That's going to dampen the revenue growth rates, but there's a lot of demand. Look, automotive, appliance, construction, container, transportation, bridges. These are just some of the end markets. There's a lot of demand there. And even if we make the case that, the supply chains are going to cause a little bit of a havoc here, I think that all considered, the demand isn't going away. The end markets are just, you need to grow stuff, right? You need to build stuff. So one of the things is that investors are kind of being put off from the space because it was like deemed a kind of a not very it's a very carbon intensive industry, and investors were kind of looking towards ESG opportunities. But as it turns out, there may not be such a profitable enterprise in ESGs, and so investors are now thinking themselves, okay, probably it's cool investing in these kind of steel companies could probably work out quite favorably. And let's look here. So adjusted EBITDA in Q4 of 2020 was less than 100 million. Okay, less than 100 million, and then in Q4 21 it was 1.7 billion. So it is such a dramatic increase in adjusted EBITDA. Now, before we discuss more about the EBITDA, let's just kind of get into this and say, look, when they came out of Q4 2020, they had a net debt balance sheet of 2.9 billion. And over the period of 12 months, it went to a net debt position of 1.4 billion. So there's a very strong switch on the balance sheet. Now it's at 1.4 billion, the balance sheet of net debt. It isn't that bad. And if you think about it, right, so they just came out and they just made 3.2 billion of free cash flow. So if you have 1.4 billion of net debt on the balance sheet and you just reported over 3 billion of free cash flow, I think that's really, really attractive. I think that is in a good position. Balance sheet is really strong and has a lot of flexibility there. They talk about on the call that they're going to have meaningful incremental free cash flow in 2022. So, what does that mean? Let's just kind of start with some numbers. I think that 4 billion probably could be a reasonable amount, okay? So this will put the stock really able to buy back a meaningful amount of its shares. Now, in the case of investing in these kind of cyclical businesses, unlike asset-light businesses that the free cash flow is all just stock-based compensation being added back as a non-cash expense, here it actually is real, the free cash flow. And if we think about it, right, so they talked about at the end of Q3, they deployed approximately 150 million towards buybacks. So Q3 into Q4, 150 million of buybacks. And they're now talking about repurchasing nearly 650 million of total buybacks over the near term. So I think all considered, I think that this is really an attractive opportunity for investors. I think that there's a lot of question marks that remain outstanding, of course, but ultimately, if you have a lot of buybacks, I think that the risk reward kind of helps investors significantly. Here's another thing, right? So this is just for Q3 into Q4. The number of shares outstanding went from 287 million to 285 million. So it's just 1%. But this is 1% on the back of the 150 million buyback. Now, if they keep buying back another, let's say, 600 million, that could meaningfully improve and bring down the number of shares outstanding by, another 4 or 5%. And then you got a little dividend on top of that. So, it's not the end of the world for a business that's priced at approximately 2 times free cash flow. Also, the balance sheet, as already talked about, is looking really, really healthy. So I think that, there seems to be, a positive risk reward. Investing is always difficult, and you always have these ideas, and then in hindsight, you turn out to be, either right or wrong. But you have to kind of base your analysis at some point with incomplete information. And you never know how the macro is going to turn out. But I think that all considered, I think that this looks quite attractive. In any case, if you want to find out what kind of stocks I'm looking at right now, don't forget to check out my marketplace. It says right there above the screen, Deep Value Returns. I highlight for you high quality, actionable investment insights that I'm going to invest right now. Thank you so much for listening. See you next time. Bye bye.